Peak Wealth Management proudly presents the Trust the Plan podcast with Nick Hopwood and Jim Pilat, where we believe by providing education and guidance, we can help you retire with peak confidence. Now, here are your certified financial planners, Nick and Jim.
Welcome everyone to the Trust the Plan podcast. I'm Nick.
And I'm Jim.
And this is the Feel Good edition.
As always.
So over the weekend, Jim, we had the assassination attempt on President Trump. Crazy, right?
Oh man, shocking, isn't it?
I feel like it's kind of like, well, you'll remember where you were and what you were doing when that topic comes up in the future, you know, like 9/11 and other times.
Yeah, I would agree totally. I mean, most people think the world's gone crazy, but I don't think anybody thought that this would happen, you know?
It seems like a big time breakdown by security, right? And also incredible luck. Like, it's a miracle that he didn't get his head blown off.
Yeah, I've seen some interesting pieces that, you know, just a last second head tilt or, you know, it was that close. Can you imagine skimming his ear, but not actually? It's crazy.
And imagine if he was dead today. So you'd have, who would be the Republican nominee, right? He still hasn't nominated his vice president, right? It's supposed to be this week. So what would happen? I don't even want to think about that, right?
Yeah, that would create a...
And it's a situation where it's, you know, all the polls are leaning 7 or 8 points to Trump. I mean, would that be just Biden automatically reelected? You know what I mean?
Yeah.
It seems like it would be.
Yeah, I mean, that kind of shockwave would be, you know, unprecedented.
Yeah. And that will end our political commentary. All right, so it is the Feel Good edition, so let's talk about market returns and how, you know, it's been a pretty good year. So let's shift here. Let's pull up this slide here. Don't give up on the bull market. Oh, you know what? I'm getting ahead of myself. There's the photo that will, you know, be famous forever.
Yeah.
Okay, so how do stocks do after major events? So maybe we're blocking the screen a little bit here, but you know, we've got the Trump shooting here as a major, you know, geopolitical event. We've got others like, you know, Hamas attacking Israel, Russia invades Ukraine, and the question is, you know, how does the market do in the coming months and years after these types of events? And you know, maybe the Trump shooting is a non-event relative to some of these because it was just really just a what if. Imagine what could have happened.
Right.
You know, it's not like JFK, right? And he's not even the president.
Right.
So,
like Reagan.
but like we took a lot of calls in February of 22 with Russia invading Ukraine. Take me out of the market. I don't want to deal with this risk. Well, right now we're much higher than we were in February of 22, and we did have weakness after that invasion, as we can see here. The 12 months following the invasion, the market was down 7.1%, right? But, you know, it wasn't cataclysmic, right?
Yeah, absolutely. I think it's totally common for markets to have a knee-jerk reaction in a negative way, but that doesn't mean that the long term, you know, is going to be bad. And it's hard to know. I mean, a lot of these recover quickly, right? The news kind of blows over, people digest it, and it's a non-issue anymore. So
yeah, look at Israel. If I told you we were up 20.9% higher 6 months after the Israel attack, would you believe me?
No, it is surprising. Yeah.
Right. So there's all kinds of events like this going back to, you know, Pearl Harbor, and there are some just terrible times in the market, but there's a lot of good times as well. So it's not always, you know, a guarantee that things are going to be bad.
Yep.
All right, now let's get back to this calendar year. So in 2024, the first half of the year has been up double digits for the S&P. Not for all of the indexes.
Yeah.
Certainly not the Dow, but for the S&P. And so going back to 1954, this chart shows when the S&P is more than 10% up at that time, at the June 30th mark, what is in store for the rest of the year. So interestingly, we can see here, the average return 12 months out is 7.7%. The median is 9.8. And it's higher 82% of the time. That's pretty good, right?
Yeah, I mean, that's great. Those numbers look good. And I think I've seen other things like that as well, where, you know, if you have you're a few months into a bull market, a lot of times it can continue. And I think that we're pre-programmed to say, market's up, let's get out while it's high, right? And you always want to be in and out at the right time. And this is just more reassurance that sometimes when the market does good, it can keep doing well.
Yeah, like the title says, don't give up on the bull market.
Yeah.
Implying gains could be continuing.
Yeah.
Now let's compare that to the average year, 1950 through last year. The average second half of the year, 4.8. You know, if we think about like 8, 9, 10% as an average year,
Mm-hmm.
it would make sense that the second half of the year average in all years is 4.8, right?
Mm-hmm.
And the median 5.6, again, very similar, and higher 71% of the time. So this is, you know, a pretty good set of data here, and it tells us that the average for the year when we have a good start is higher in the second half than in all years, right?
Yeah, and I think it's worth noting too. You can go back to say, well, what if this time's different? This is an election year, or this is this, or this is that, right? The chart we showed, you know, or the table we showed a few slides ago, there's always some sort of event coming. There's always some, you know, this time is different type of event happening, but as that chart showed us, oftentimes the market's still higher, you know, 6 months, 12 months down the road.
Yes. So also on July 11th, which was last Thursday, we had a very interesting day in the markets. And normally, you know, one day you can't make a trend out of one day, but it was so unique, Jim. We've seen small caps underperforming. We've seen the Dow type stocks underperforming the large cap tech stocks dramatically over the last couple of years.
Yeah.
So on July 11th, we had a day when the small caps outperformed the large caps by over 3%. This does not happen very often. It happened at the low of 1987, the low of 2008, the low of 2011, March 2020, January 2021, and November of 23. These are all pretty bullish times, right? If you look at the market returns after these events, they were substantial. And so, you know, I'm not looking in the crystal ball here. We're not making any recommendations. This is just some commentary about what we're seeing. But when we have these types of days where the small caps outperform the large caps by this much, it could be a signal that rotation is coming. So think of it like this. The NVIDIAs, the Microsofts of the world have been leading, those big tech names.
Yeah.
And the small caps have been trailing. Well, when you have a day like this where the small caps are outperforming the large caps, and specifically outperforming those magnificent 7 by even more. By the way, the Mag 7 was down -4% in aggregate on the last Thursday. So you have plus 3% to -4, a 7% outperformance.
Yeah.
This could be the beginning of a rotation where we see global value, small caps, maybe start to take a lead here.
Yeah, I mean, I think that's a really interesting. I mean, it's not. I think to say the Magnificent Seven has been leading is an understatement. I mean, it's been carrying the market, right?
Yes.
And whenever we look at why can the market keep going higher, it's because of rotation. It's because of participation by, you know, value companies, mid caps, small caps, international. These are all areas that have significantly lagged what those growth companies have done. So I will say this is, you know, the time where we can talk about, you know, a reminder to stay diversified, to stay fully invested, to not, you know, try to put all your eggs in the growth basket because it's the one that's going up the most, because sometimes it doesn't, right? And when it doesn't, we want to still be able to participate.
Yeah, and I agree with that statement completely. Now, what about bonds? So last week or 2 weeks ago, we had our halftime report, and we had PIMCO speaking, and some of the PIMCO thoughts I agree with completely in terms of where we want to be in the bond market and what might be coming next in bonds. And everyone's always talking about the money markets, right? We can make 5% in the money market or in a T-bill, so why would I look anywhere else?
Yeah, I mean, it's, you know, the risk, there's hardly any risk at all in a money market. It's about as safe as you can be. So, I mean, there's that, it's attractive, right, to have a good return on money like that. But, you know, we just know, and PIMCO reiterated this, when rates go high, as long as they did, it pushes down the value of those bonds, and we know that we're either going to keep collecting a good yield or we're going to get price appreciation on the bonds. So that really is, when we think the Fed is done hiking, which they definitely seem to be, and potentially cutting, it really makes for an attractive time to consider rotating into putting in a little more risk on the table by venturing into bonds instead of the money market.
Yeah, and they specifically said when the Fed had their last hike, which was July of 23, about a year ago, that is the best time to buy bonds.
They did.
And so we're a year in. I don't think you've missed much if you have waited. Okay, but I think it makes a lot of sense, especially if the Fed is going to start cutting soon. And I think maybe last Thursday was the market getting a sense of the first cut coming soon.
Yeah.
We'll see. Okay, let's talk about drawdown, because it's not all rainbows and unicorns, right? Just because the average return for the second half after a good start is 7, 8, 9% doesn't mean that it goes straight up.
I think that's a great reminder.
This is a little blurry, unfortunately, but this shows since 1950, so same data, when the first half is, first half positive, first half greater than 10%. So this one, it still has, the second half still has a drawdown on average of about 9%. So it I don't know if it's going to be October, usually October, it could be weak or whatever, but something's going to happen. There's going to be a drawdown, and I don't know if it's going to be election related or we have no idea, but something will happen and we'll have a drawdown, but then still, right, the other data still holds, right? Yeah, and there's the 7.7 average percent gain. So this is from a different source, from LPL, our old buddies at LPL. So it's good to see that data conforming.
But I think that's just a great reminder, because just because we think, and we don't know obviously what the next 6 months will hold, the numbers it indicates, it looks like the market could be good, but that doesn't mean it's going to go up, 3, 4, 2% a month for the next 6 months, and we're going to be great. It just means it goes up, it goes down, it will zigzag, it will move. But again, just a reminder to stay fully invested and to not try to time the market.
And coming full circle here, talking about the politics of everything, in an election year, the average drawdown is 9.6%. So very similar to a lot of the other time periods here. So all in, we were comforted by the data. But we recognize that it's not a straight line. So if you have a portfolio of 500,000 or more and you're interested in speaking with us for a second opinion, please reach out to us at peakwm.com.
Peak Wealth Management thanks you for watching and listening to the Trust the Plan podcast, featuring certified financial planners Nick Hopwood and Jim Pilat. If you enjoyed our program, please subscribe and share. If you'd like to learn more about our services, please visit peakwm.com. peakwm.com today. See you next week.